Ladies and gentlemen, we got a big interview lined up for you. Here is my managing editor, Nikunj, Dalmia, in conversation with Nicholas Nassim Taleb, renowned author. He's, of course, written that famous book, Black Swan and Skin in the Game. Here's that conversation.
The Federal Reserve has lost one weapon, interest rates, because at zero you can't really go negative. There's arbitrages, but they have the monetary policy arm. Is not just lowering rates. They can print money to buy your commercial paper, okay? The commercial paper of a Maltese bank in New York, they buy it. Anything they see that's on sale, they buy. So that definitely will prop up the stock market for a while. But remember, okay, nothing is permanent, okay? When they stop buying, or if they realize that what they're doing may be inflationary, okay, then things go back to normal. So the one thing I've learned in the life of 37 years since I started trading, very counterintuitive, is that recessions are very good for stocks because the reaction to recessions makes stocks rally, and booms are very, 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 very bad. They make the stocks very volatile because, of course, they're going to raise rates and people have substitutions into bonds. So this is one of the reasons why stocks are not collapsing. But if outside the stock market, okay, which which is investor-led, by people who just put money but not work. If you walk around, you see nothing but businesses closed. So you have entire sector that will not come back. So number one, rotation from sectors like real estate will do very poorly in the office building. Okay, and of course, in retail, because people are buying now on Amazon, will do poorly. Other industries doing well, and over time, the economy overall will adapt to that. Will adapt in the sense that I'm adapted. Look, I'm a professor. I have a studio now in my home, where I have a blackboard to lecture on a blackboard. I'm adapted, and it's actually a lot cheaper for universities or for conferences to take place online. Okay, you don't have to fly people in. You don't have to, clean the offices. You don't have to, provide food. Everything's much more convenient, and you're cutting down on commuting time for a lot of employees. So I am adapted in that sense, and I mean, I hope for the best. But if it doesn't happen, I am adapted. A lot of farmers also are adapting. So we have an adaptation period. It seems to me that within 2 or 3 months, we'll be so adapted to this that some people will thrive and will even regret normalcy. But I don't think we will have normalcy for one reason, unless there's a miracle cure. And we know what happens with miracle cures. You have, they make the front page of. At a time, there was a rule: if a cure makes the front page of Newsweek, it's not a cure. Right, that was the rule in 30 years ago. So like interferon, cure for all viruses? No, okay. So if we have a cure, of course, people will wait for side effects, failures, maybe a vaccine that doesn't really adapt to new mutations of the virus. So even if we have a cure, people will still be paranoid, okay, and will not gather in bars unless, we're talking about young people maybe, but reasonable people will not gather in bars, will not go to crowded places, will not get into crowded elevators, will not go to crowded, if they have the chance. And it looks like they have the chance, you see. And even the restaurant business can adapt. Like I'm now in Atlanta as a refugee, but I have a place here and I'm enjoying it. And I've noticed that there are restaurants that are entirely outdoors. And these can thrive in this new environment with the proper distancing and ventilation, okay? But of course, you can't do that in the middle of the winter in New York. So there'll be losers, permanent losers, even if we have a semi-cure for the virus, or announcement for a cure. It will take a long time for people to really believe that it's risk-free to go to crowded places.
India has so far managed to contain the virus. On the medical front, the lockdown has been a success. But do you think in the medium term and in the short term, this lockdown is going to cost Indian economy a lot?
I think that it's a false dichotomy again. It's a false economy. Maybe the money you've saved from a short lockdown, you see, when you have a short lockdown, you save money for later, okay, compared to, think about New York, think about the United States. Because although either we don't have a lockdown, there's a drop in economic activity and we're prolonging the effect of the disease. So I think that India had a very reasonable policy. India, Taiwan, Hong Kong, New Zealand, Australia, these many countries had very reasonable policy. They acted early, they acted wisely, they acted according to precautionary principles, and they had a morally acceptable stance. And let me talk about, if you don't mind, about my moral stance. Saying we're going to sacrifice the elderly because you know what, we don't need them anymore, is something that would not cross any mind outside Sweden or some countries, some rich countries. Okay, so what we call geronticide, killing the elderly, by saying this disease doesn't affect the young, which is actually bad reasoning because we know that disease also affects many young. Okay, and we don't know, as I said, the long-term effect. But seeing these stances, okay, that they're morally not acceptable to many cultures, and including the Indian culture where you have respect for the elderly. You see, they're not accepted by Mediterranean culture because for the Romans, senatus means the older person. This is why they had the Senate. The Senate is the council of the elders. Okay, so not only you wouldn't kill the elders, but they had a prominence. And the Arabic word shaykh, what does it mean? It means older. So seniority in age was effectively social seniority, intellectual seniority, and political seniority. So what we're facing here is a divide that few are noticing between the two worlds. Okay, the world that has the ancient world imbued with ancient values, and a new world that succeeded economically over the past, say, 75 years, okay? And now we're seeing that maybe the moral advancement is not there, and that's gonna cost them. And even then, now Sweden, for our friends here who don't know the story, has decided to let the thing go. Okay, they say, okay, we'll burn through the population, we'll kill a few people, and then the young will not be affected, which is turning out to be a very bad idea because many young are affected. We don't know if something they call herd immunity works. We don't have no idea. And what is worse is that their economy is also suffering. You see, this is the poetic justice is not only they're killing the old people, but their economy is also suffering. So this is why, I mean, so sometimes people put you in front of a dilemma. Okay, this is a cost-benefit analysis, and a lot of countries, including India, including countries in Southeast Asia, countries in the Middle East and the Mediterranean, would refuse that on moral grounds.
Before I get into India's specific question and we start talking about risk, as a statistician, I'm sure you've studied viruses and the history. This virus has seen a winter and a summer. It has survived. Monsoon is about to come. It has only started in Japan and parts of China. Do you think the virus could spread more, or it could be normal?
Okay, we don't know. The idea, you see, let's look at the reasoning on why we're talking about pseudo experts. That we've discovered, my friends and I, we study macro things, okay, macro properties. I just have a paper coming this week in either this week, next week in Nature Physics on what we call the fat tails of pandemics, which is effectively what drove me to write that comment that you nicely put in the Black Swan. I mean, the comment in Black Swan that I nicely mentioned. That was driven by some kind of, anecdotal empiricism I did that we formalize now with Nature Physics. You look at the macro property, the systemic effect, not you don't go from a micro to the macro, you go from macro properties to micro decisions. So it turns out that people involved in medicine were too myopic to understand that maybe it's not the thing you have. Whereas when you look at macro, you're much more skeptical about claims. So in the beginning, they thought it was like SARS. And on January 26th, when we issued our warning, we said, maybe it's like SARS. Okay, we're all okay. Maybe it's not. Okay. So now there are a lot of things saying maybe it's not. So the claims were initially that don't worry about it. Wuhan, that was in January, has a harsh winter. Look at on TV, all their hats and stuff, therefore countries that are warm don't have that. And effectively the influenza, okay, and people thought, oh, just another flu, maybe a little worse, but within the same category. So they had a category error. So they thought that viruses, okay, this class of viruses, for some reason, okay, do not like summers, either because more people are outside or maybe because the nature of the virus doesn't survive on surfaces, whatever. And then they had a lot of theories. And then we said, you can't, okay, because we still don't know enough to make these assumptions. When you model, you had to look at the macro properties that are robust and common to all diseases. And the more you know, the more you can narrow it to a category and say, oh, less harmful than, but here we still don't know in the absence of information. Okay, and we still have no information. We still do not know anything about, people were not recommending masks till recently, when in fact masks would have saved the US economy, you see? So even the President Trump doesn't use masks, but they realize that from the beginning, okay, they thought that like some other viruses, it was transmitted by contact, not via aerosol or droplets in the air, and it's turning out not to be true. And masks are incredibly effective, okay, for things that are respiratory because it's filter on both sides, okay, and compounding the filter works very well. After 2 or 3 person, you can pretty much lower the transmission. Anyway, so what I'm saying, so to summarize, it is, we cannot make assumptions of seasonality before seeing a lot of seasons, okay? So I would stay on a maximal alert. I would hope, that, summers would high temperatures, humidity will harm it. But in the meanwhile, I would wait.
Okay, now before I shift focus to risk and asset allocation, I'm going to just read off for everyone in the webinar one quote of Mr. Taleb. People have the problem of denial. This is one of the biggest things I have learned in the Lebanon. Everyone who left Beirut when the war started, including my parents, said, oh, this will last 2 weeks. It lasted 17 years. I guess that is what he's trying to refer to this virus. Please don't be in a denial mode. Learn to live with reality that virus is here. Like he told us a couple of days ago, plague lasted for more than 200 years. So I'm going to just shift focus, Mr. Taleb, and talk about what should one do. You're a risk taker, you're a trader. Yeah. Let's understand where are you investing and how are you investing personally?
Okay. Yes, in Skin in the Game, I said that I will never recommend anything that I don't have myself for moral reason. That way, if my recommendation is wrong, I lose money. It's good. I'll have good conscience. I hate gold. I've always hated gold. Unfortunately, I own gold. Okay. I hate European currency. Unfortunately, I own some European currencies. I like land. Okay, so I own land. I own olive trees. It's not economical for now, but I feel comfortable. Why? I feel it's a good repository of value. So now let me tell you what's driving my thing. I have 2 fears. Okay, one fear is of deflation and one fear of inflation. And I've learned through history that there's no such thing as inflation anymore. Okay, there's hyperinflation or nothing. Okay. So now we are in a deflationary environment, okay, not for some things, okay, but typically you can feel a deflation. It can switch very easily because it's throwing so much money at it into something great. So I want to hedge to make sure my funds, my savings, that they are unaffected by both deflation or hyperinflation. Okay, so I have a large portion in things that for paranoia. I am making bets. Odds are I will lose on them, but they're hugely protective bets against long-term bond rates. because I think that eventually, if they keep at some point, even the government of the United States, you see, if the Chinese stop buying bonds, okay, the Arabs stop buying bonds, even the government of the United States may not be able to issue bonds to pay for this, okay? So you cannot, and you cannot just have the Federal Reserve buy your bonds, okay? It becomes sort of so circular. So, and I have, of course, what we call tail risk hedge. And I would like in phase two to invest in some businesses that are both robust to recovery from this and robust to the virus. You see, some companies may not be robust to the recovery. Like, for example, delivery services. Okay, a lot of people may not be. You know, these are booming. Where I live, you have food delivered, stuff delivered. So Amazon may suffer a little, okay, if you have normalcy, but there are some businesses where I think like what we're doing now, Zoom or some other, they may gain because we've discovered a new way of doing business, and a lot of employees would like to stay home independent of the virus, simply because they find it more effective to not commute. Some people commute for 3 hours to New York City. So there's some habits that would be permanent. So try to identify companies that are robust to both the recovery and boom during the virus. Then, and as you said, I would hope that this will last 2 more weeks, but I will act as if it's going to be 17 years. So there's a difference between you know what you hope and how you act.
If I increase the time frame, which is terminal. A lot of experts use that. Let's look at terminal investing. 1 year, 5 year, and 10 year. Would you still like to buy gold in every basket?
Okay, so let me tell you one thing that one dogma I have. You should invest for tomorrow and you invest for 100 years in exactly the same way. And let me make an anecdote. The main difference between an investor, what's the difference between an investor and a trader? Well, a trader who loses money on his trade becomes an investor. They say, oh, I'm in it for a long term. If they make money, they get out. So you cannot divorce. If you depend on what happens tomorrow, if you cannot say I invested for 100 years, if you ever had to change allocation tomorrow based on new information, then you're investing for 1 day. So this and this is a big thing, and actually it was strangely enough in my first technical book published 23 years ago, Dynamic Hedging, where you explain that it's what I call the Markov property. You see that there's no and effectively it's a wrong way to approach problems. I want to invest for tomorrow, okay, but I treat the same way. So and it's the same reasoning as saying, oh. Plane crash. We have plane crashes on average every 20 years, but I'm only going to travel for 2 days. You can't really, it's a memoryless process. So this is how I treat it. So I would treat everything at both short-term and long-term, okay? And I would say everybody should do that. Because if you invest in say I'm investing for 20 years, if there's any reason for you to change allocation tomorrow, because you found something monstrously more attractive, okay? You saw the great mansion, someone's bankrupt, selling it, and you switch out into this, then you're effectively investing for 24 hours. You see, this is what I call the memoryless investing, okay?